But I think we can take it across to Nikunj. He's got Jayakumar from Prime Securities joining in with him. Start of the year, so would like to hear from Jake's his views on all the top 5 Qs that we're planning to post to him. Nikunj, take it away.
Well, it's time to talk the big picture, Outlook 2019, time for market makers. Thank you for tuning in. 2018 has been a year where irrespective of which asset class you invested in, the experience has not been very rewarding. But after a really bad year and after a gut-wrenching fall in small and mid-cap stocks, is it time for a big blowout year? Or this is going to be a pedestrian year given the bent of the economy and the scope of events and the level of valuation? So to discuss about pockets of opportunity, Outlook 2019, what is the view on the large cap stocks and how real could be the comeback in small and mid cap stocks? I have with me Jayakumar of Prime Securities. Jake, fantastic to have you back and thank you for joining us.
Thank you for having me over.
The concerns which were haunting US markets at the eve of Christmas, which was fear of a trade war, extreme volatility in FANG stocks and nervousness from Fed, all of them have got addressed. The lay of the land for global markets has changed, but for India, can you say the same?
Well, I'm not sure all of this have got addressed. I think in the short run there's been some kind of a palliative that's come through. I think calming words where things have not got escalated. I think FANG stocks are still off on an average about 35% off their peaks. Most of them, or let's say 30% off. The big ones that hit almost 1.1 billion in market cap. Apple's down to about 720. The others had, Amazon had crossed $1 billion. It's down to about 800 now, etc. So I think not everything's got addressed. I think there have been sharp corrections, and even in India, for instance, I think you've seen if you take TCS or Reliance, some of the big stocks, the two biggest market caps, if you will, are off 15 to 18% off their highs. The index is down, hardly 8-9%. So if you look at it from that perspective, 3-4 months is a decent, it's not short term. It's from an investor's perspective, it may be short term, but I think a lot of headwinds and to some extent tailwinds in terms of oil cooling off, etc., have all come together. So in that context, very interestingly, so many mid caps and small caps are 15, 20, 30% off their lows. Pretty convenient, in fact, some even more. And they have actually outperformed some of the big stocks. So when I was here last, we talked about stock picking is truly in. Yeah. I think while factors at the macro level have changed quite dramatically, but the reality from an India perspective is that dollar rupee has gone back to now, let's say, a stabler 69-72 range. Slightly, I'm talking about the next 3-4 months. I see interest rates coming down to 7.25, 750, which they are currently at, to well below 7. Of course, there's liquidity that's going to be required, as the elections, come closer. There is the issue, I think, of oil. You've seen 85, you've seen 50. My own sense is we are headed a lot lower. This could be a bounce in a bear market in that sense from an oil. Oil is definitely in a bear market. So given all this, I think the headwinds for India have disappeared. I think clearly the tailwinds are there. But until these elections and this growth around the credit that the NBFC sector was providing, until that's addressed, you're going to have 11,200 to my mind as pretty much a floor, as a roof on the markets. And the floor of 10, 10.2 maybe has risen to 10.4, 10.5, but it's become a lot more solid.
I'm going to take the clock back. Normally we should take the clock forward, but I'm going to take it back. 2018, the setup was extreme optimism in small and mid-cap stocks.
Sure.
The general view was that 2018 will be a great year for economic recovery and earnings will come very, very strongly.
Right.
2019, the positioning is very different. There is scare in mid and small cap stocks, but there is a strong positioning in IT, to a large extent corporate banks and some consumer names.
So you in a sense answered the question, right? So where there's fear, please look more closely. I think the important thing is that the market's telling you that while it may have made a very robust bottom at 10, 10.2 and has gone up thereafter, but the interesting thing it's telling you is that the winners are going to be very different. So I believe that this quartet of SBI, BOB, ICICI, Axis, I'm still talking as a sector, but actually taking these 4 specific stocks.
They are the obvious names.
In terms of being positioned for this. Why? Because the NPA cycle is pretty much run its course. Recoveries are on. Non-performing funds have now become performing assets as the recoveries come through. The biggest thing is this buyout of portfolios of NBFCs. So the space that the NBFCs have ceded in recent times is now being taken up back by some of these banks. I think you're going to have, and I'm not here talking about necessarily an HDFC or an ICICI, I mean a HDFC or a Kotak or those who never had the issues in the first place, but those who've gone through the problems and are now coming out, I think are going to be, I think the earnings that these banks will show you in the next few quarters will blow your mind.
Will you apply that on Yes Bank also, because it's a bank which has gone through problems but is coming out?
I'd rather not talk about Yes Bank.
Okay, let's talk about the positioning of corporate banks. There is a lot of merit in what you are making, the scenario what you're constructing, but this seems to be a consensus scenario. I had a couple of folks over from Edelweiss last week. We had a couple of folks over from the fund management industry. There seems to be a consensus which is growing in favor of corporate banks.
But if consensus results in ownership having been created, with SBI having moved to 250 or 240 to 300, then there's no question of a bull market. I don't believe there's anything remotely close to over ownership. Please understand that SBI...
How do you define that?
So I'll tell you. Over the last 2.5, 3 years, you had the FIIs consistently selling quarter on quarter, month on month. For the first time in the last few months, you've seen some bits and tidbits of buying. Net buying is just about to come in. All these stocks that I've talked about were the ones where they got their liquidity from. You need to have substantial transfer of ownership back to those folks, and a lot more buying in these stocks that would come in. I mean, for the first time you've seen ICICI now touch its lifetime high of 380 or whatever. I think if you ask me, just because 4 people have articulated this thought over a 1 month period doesn't make it over-owned in that 1 month period. That's the thing. So we should distinguish between 4 similar views and a consensus in terms of ownership and where money has gone in.
Sometimes I personally feel that I've started living in an echo chamber because I interact with those whole 10-15 people who are the smart guys, and I think that's a consensus view.
Well, I don't know. I mean, that puts me also as one of the smart guys. I don't know about the people you interact with, but the reality is that this can't be a sign of over ownership, and I certainly won't believe that a move on the index of 10% off its lows or 8% off its lows, recent lows, and a 1 month view where some stocks have gone up 15% necessarily indicates consensus ownership. No. Number 2, Pharma. That's now a stock space with only value people who are looking at it in some form or the other.
Is Pharma cheap, Jakes?
I think
that 15-18 times.
But there's a difference, which is that it's come off. If you see some of the leaders, they have corrected 70% from their peaks. I'm not necessarily saying you go for those, but I think in Pharma the important thing has happened is this Teva announcement at the JP Morgan conference in San Francisco
earlier this week,
where they talked about price stability for the next few quarters. I think that's mega news, because the moment you say price stability and you say that the rupee is now not in the 64-65 range but in the 70-71 range, and you talk about most of these balance sheets being unlevered and somewhere there is some small leverage actually acting as a positive ROE kicker, you're talking about a scenario where I think Pharma could be a surprise packet. And certainly the under ownership in the last 2-3 years coincided with 3 or 4 sort of factors. One was of course the pricing scenario. 2, I think was the FDA approvals and these inspections which were creating these disruptive risks, event risks in the business. Now I think a lot of that is behind. So if you handpick 2 or 3, again I don't want to go into name specific, but I think they could be surprised 30-40% upsides from here in the next 12-18 months.
Like the pharma sector can be divided into 2 or 3 large pockets.
Right.
US generic based companies, companies which have a non-US focused market, pharma companies which have a debt, and pharma companies which currently are in a very advanced research pipeline. So which end of the pharma space you like? Because it's very large.
So I think the way I would look at it is generics moving to complex generics. So there are companies that are moving into complex generics, into biosimilars, peptides. So it's the higher end of the, and exploiting the US markets. Coincidentally, 1 or 2 companies that in that space we like have leverage. But the leverage is easily addressable through earnings. And they've been making smart acquisitions recently. So those companies with a little amount of leverage actually gives ROE, because cash on the books usually is not, not always put to the best use. And therefore, surplus cash companies have made mistakes as we've realized. So I think companies in that space, I think some of these companies have been making good moves into Europe as well. But I think the India story, the pharma story around India, I'm not too sure if there have been too many plays there which have done sort of mega work, as it were, in terms of providing returns to investors. So I still would focus on US generic, but moving to complex generics, higher end peptides, biosimilars, and presence in other markets like Europe as being critical in this thing, because I think the rupee is going to be a positive tailwind. There's no question.
The general view is that you're optimistic.
Yes.
You're optimistic on the economic recovery.
Right.
Now, economic recovery will be a function of corporate recovery as well as consumer recovery. But just when we thought that consumer recovery is going to be increasingly better, auto dispatch numbers have been poor. Four-wheeler companies have started giving profit warnings.
Sure.
There is a price war and a fear of market share. Typically, when there's a slowdown, you have all these factors at play. How should we read into the auto dispatch numbers, which were bad for November, December, and October also?
Well, I would say just go back to our conversation with you in October end, October early, when we talked about how
autos has become crowded.
Well, more than autos, we talked about the fact that the entire consumer spending would come under a lot of issues because of the NBFC funding being a problem. Today, let's not run away from the fact that the NBFCs may have avoided a cannonball in this last set of episodes, as it were. But what they have ended up doing is cruelly exposing the fact that credit is required on a continuous basis for consumption to continue. The moment that drops off, and their own growth plans have actually become a little, sort of unsure, as it were, what do you end up with? You end up in a scenario where immediate months numbers, I think you'll have further slowdown evident in terms of credit not going where it ought to. Individual companies may do well, but as a whole, the sector was blazing its, trailblazing on the growth front. I think that's going to be a big problem. So the consumer growth, I think, even on the housing, I think we're going to see a definite deceleration of the pace at which the growth has taken place.
So if the consumer slows down, it will have an indirect or direct impact on the industrial demand,
That's
on
correct.
the capex demand.
That's correct.
Can they both parallelly exist, that industrial demand and capex demand comes back and consumers start slowing down?
Well, the way I would look at it is that new capex is difficult to come by.
Okay.
I think a lot of consolidation that's happening. I see consolidation in the NBFC space. I see consolidation in things like power and other things, where a lot of assets that have been put up for whether it's the SBI Samadhan scheme or it's the scheme for resolution of stressed assets. I think those are the assets that will get picked up. So, for instance, the JSWs and the Tata Steels and the Arcelors are acquiring capacities that have been mothballed or shut down or operating at lower utilizations. So there's going to be capacity increase from that perspective. I don't see fresh capacities coming up in most places. The consumer side of it was, whether it was durables, whether white goods, whether it was auto, etc., that's definitely going to meet with a lot of challenges for reasons that I mentioned. So I'm not that optimistic on growth, going sort of unchallenged, as it were, and that we'll continue growing. I don't see that happening. Especially in the run-up to the elections, I think this is going to be the need to spend will be high, but at the same time, this may be just a sort of pre-election issue. I think there are some structural issues on whether we want NBFCs in the system. I think RBI and others need to come out and go back to those, maybe models have to be tweaked, risk management they keep talking about has to be addressed. But I feel that the NBFCs are here to stay. And the sooner we recognize that they've been providing credit and collecting where other banks have not been able to do so. And that's the reason they've been here. They've not been here because just somebody one day wished that NBFC should be there.
They've done all the heavy lifting when banks were not lending. I mean, that's
over there. And most importantly, they've got the risk management collections. They're more fleet-footed. They're more able to respond to market stimuli. And I think we can't run away from the fact that that kind of presence is important. Para-banking exists in every country in the world. And I think this governor has taken some, for starters, has engaged very readily with people, I think, which is, kudos to him. And I think, notwithstanding the naysayers about, whether governor change is good, bad, etc., I think the reality is that he's immediately addressed issues of liquidity and taking issues, head on as we speak. So, I think that orientation is important.
One fine example is that we've always called RBI as a great institute. But it's only that the two previous governors were economists. Before that, it was bureaucrats who were running it. And RBI did a great job of managing the 1999 or the Asian crisis or 2008 crisis.
Well, I think we only understood that in the context of, when somebody left, and therefore you have to check out some of this stuff. But I don't think educational qualifications matter. I mean, people have done their job by, hit the road running, as it were. And, So I think it's great to have economists talk about it, but we've also had problems where economists have been seen to be too theoretical and not, accepting realities on the ground. So it works both ways.
Now, for markets to do well, business have to do well.
Sure.
We talked about NBFC space. Let's talk about your own business. 2019, how's been the start for your firm?
Well, I wasn't kind of ready to talk about Prime, but actually one of the things that's happened is we are now purely investment banking, so 100%. So we're in the debt markets, we're in the equity markets, we're in the restructuring space, we're in wealth and investment advisory. And I think we've never seen, not specifically 2019, but over the last couple of years, we've never seen in my 30 years plus of working where people are willing to pay as readily and willing to pay as much for advice. In the past, it used to be people would call you, you'd sit and chat, and then say fine, and then you'd realize later that they implemented what you were saying, but they didn't really pay you for it. Today, I think investment advisory or restructuring advisory is big time being sought after, and I think so in the financial services advisory business is actually booming, and from that perspective, I think knock on wood, but we have no complaints.